Thinking of buying a home but confused about mortgages? You're not alone. The biggest decision you'll face is choosing between a fixed-rate mortgage and an adjustable-rate mortgage, and making the wrong choice could cost you tens of thousands of dollars. In today's video, I'll break down both options in simple terms, show you the pros and cons, and help you figure out which one makes sense for your financial path. If you're buying a house, there's a good chance you've heard the term mortgage. In fact, it might be the only thing you know about home loans. But here's the thing, mortgages are complicated. They confuse most home buyers, and it's easy to get overwhelmed by all the choices you have. The biggest choice you'll face when shopping for a mortgage is whether to go with a fixed rate or an adjustable rate mortgage. And if you pick the wrong one, you could end up paying tens of thousands of dollars more than you need to. So in this video, we'll break down the differences between these two types of loans, so that you can decide which one is right for you. Let's get started. First, let's start with the basics. What is a fixed-rate mortgage? A fixed-rate mortgage is a type of loan where the interest rate stays the same for the whole life of the loan. This means that your monthly mortgage payment will also stay the same. For example, if you get a 30-year fixed-rate mortgage at 4%, you'll pay the same amount each month for the next 30 years. That makes fixed-rate mortgages predictable. You'll always know how much your monthly payment will be, and you won't have to worry about any surprises down the road. This can be a great benefit if you're planning on staying in your home for a long time, since you won't have to deal with any sudden increases in your mortgage payment. Fixed-rate mortgages typically come with terms of 15, 20, or 30 years. This refers to the length of time that you have to repay the loan. A 15-year fixed-rate mortgage means that you'll have to repay the loan in full within 15 years. A 30-year fixed-rate mortgage gives you twice as long to repay. Generally speaking, the longer the term of the mortgage, the lower your monthly payments will be. However, you'll end up paying more interest over the life of the loan. Next, let's look at the adjustable rate mortgage. Unlike fixed-rate mortgages, RMs come with interest rates that can change over time. But don't worry, your rate won't change every day like the stock market. Instead, ARMs have a set period of time called the introductory period during which the interest rate remains fixed. After that period ends, the rate will adjust periodically, such as annually or every 6 months. How often the rate adjusts is specified in your mortgage agreement. For example, a popular type of ARM is the 5/1 ARM. This means that the interest rate will remain fixed for the first 5 years of the loan, and then it will adjust once per year after that. Once the introductory period ends, your new interest rate will be based on an index that tracks broader interest rate trends, plus a margin set by the lender. These margins vary depending on factors like the lender's risk assessment and overall market conditions. The main benefit of an ARM is that they often have lower initial payments than fixed-rate mortgages. This can be especially helpful for people who plan on selling or refinancing their homes within a few years. For example, if you plan on selling your home in 4 years, it may not matter that your mortgage payments will increase in year 5, since you'll no longer be responsible for that property at that point. If you plan to refinance before your adjustable rate kicks in, you could lock in a new low-interest rate mortgage before the introductory period ends. Just keep in mind that there are usually fees associated with refinancing. Now, before we get into the pros and cons of each type of mortgage, if you're finding this information helpful, hit the like button and subscribe for more tips on growing your wealth. Now let's talk about the pros and cons of getting a fixed rate versus an ARM. First, let's look at the fixed rate mortgage. The biggest pro of a fixed rate mortgage is, well, the fix. With a fixed rate mortgage, you know exactly how much your monthly payments will be for the entire life of the loan. This makes it easier to budget and plan for the future, since you won't have to worry about any surprises. Plus, if you plan on staying in your home for a long time, you'll save money on interest by avoiding rate increases that might have otherwise kicked in. A fixed-rate mortgage is also a safer option if you're worried about rising interest rates. If rates go up, your monthly payment won't be affected. This can be especially beneficial if you think that interest rates might rise in the near future. On the other hand, a fixed-rate mortgage also has some cons. For example, the interest rate may be higher than an ARM, especially in the beginning. This is because lenders typically charge a slightly higher interest rate on fixed-rate mortgages to compensate for the risk that the interest rate might rise while they're holding the loan. If you plan on moving or refinancing within a few years, you might end up paying more in interest than you would have with an ARM. Additionally, even if you don't plan on moving, a fixed-rate mortgage may not be the best option if you think that interest rates will fall. And now let's look at the ARM. The main pro of an ARM is that it offers lower initial payments than a fixed-rate mortgage. This can be especially helpful if you're looking to buy a more expensive home, or if you need to keep your monthly payments low for other financial reasons. ARMs also give you flexibility. If you think that interest rates will fall in the near future, you could refinance your home and lock in a new low-interest rate mortgage. If you plan on selling your home before the adjustable rate kicks in, you won't have to worry about the consequences of rising rates either. On the other hand, ARMs also come with a fair amount of risk. Since the interest rate can change periodically, your monthly mortgage payment isn't fixed, which means that your payment can go up or down. Plus, if the interest rate rises, your payment can increase significantly. That's why it's important to consider your personal financial situation and future plans before deciding on an ARM. If you're not comfortable with the risk, or if you plan on staying in your home for a long time, you may be better off with a fixed-rate mortgage. Ultimately, the decision of whether to get a fixed-rate mortgage or an ARM comes down to your individual circumstances. If you want peace of mind and you're staying in your home for a long time, a fixed-rate mortgage is a safe bet. However, if you plan on selling or refinancing your home in the near future, or if you want lower payments now in exchange for taking on some risk, an ARM might be the better choice, no matter what you decide. Make sure to shop around and compare rates from different lenders to find the best deal for you. Let me leave you with this. Mortgage isn't a one-size-fits-all proposition. Your situation is unique. So the right choice for you will depend on your particular path to wealth. Fixed means stability. ARM means flexibility. Ask yourself, which path do you want to take? Thanks for watching. If you enjoyed this video, you'll definitely want to check out my video on should you pay off your mortgage early. See you there.